Gold is extending its record-breaking run, topping $2,700 for the first time as investors flock to safety. Joining us now for more, we've got Phil Streible, Blue Line Futures Chief Market Strategist. Phil, it's great to speak with you. I know that you see gold hitting above $2,850 by the end of the year. What do you think is going to get us there?
Well, I think there's a number of factors. There's really two takeaways and a number of drivers that are pushing prices higher. I think it's the declining inflation expectations, also the rotation of assets that tend to perform well with a more dovish Fed. We've seen the Russell recently start to push higher. We haven't seen much of a reaction in the bond market, but as the inflation expectations come down and we start to see more of these interest rate cuts priced in, you're going to see the bond market start to push higher. And we've seen inflation pressures. They've been relieved by declining energy prices. So the Fed is more focused on the fragile labor market. They're taking more of a dovish stance. We believe that the dollar index is near some kind of peak here. And with a 54% inverse correlation of the dollar, we think that gold futures will benefit.
Phil, there has, though, been some talk that we're entering or we could be in overbought territory. It doesn't sound like you're seeing any signs of that.
No, I don't think so. I mean, there's a number of different things here. We've seen the Fed policy shifts. They're continuing to show 25 basis points. There's speculation of the outcome of the BRICS meeting. That's where they're looking to establish a new reserve-backed currency. They could bring gold into that mix. We've seen China turn around economically with some growth momentum here. Their industrial production grew by 5.4%. Their high-tech industry, which is green energy, industrial robots, integrated circuit manufacturing, those are all your other metals, your silver, your copper, your platinum, all pushing up. So you do have the election uncertainty, although both candidates have stimulative agendas, and then a technical breakout draws in a bit of a different crowd, some momentum traders. So some new speculators starting to dive into the market.
Phil, you just mentioned the election uncertainty, and that's something that certainly has been garnering more and more attention. And there's even talk that maybe gold could hit 3,000, just depending upon how long maybe it ultimately takes until we get the final results of the election. Is that something that could be in play, just given if we do see maybe a further delay than what's being priced in?
Well, it will cause some volatility in the market, but I think that it's going to more impact like cryptocurrencies, a dollar index, and U.S. equities. U.S. equities historically perform quite well, regardless of which candidate wins the election. Both of them, again, have stimulative pressures to push to the upside. One wants to spend more, the other one wants tax cuts. Historically, we do get that Santa Claus rally. And if you go back to election cycles, November historically and December have yielded on average return about 3.4%, which is higher than the 2.6 we normally see.
How big of a driver for gold do you think central bank purchasing of the asset could be moving forward, particularly if we do see policies that are a little bit more isolationary for some of these countries? Do you think that will continue to push gold up?
Yeah, the average central bank holds about 15% of its foreign reserve assets in precious metals. We've seen other central banks start to step up their purchases like Mexico, Mongolia, the Czech Republic, Poland. They've all been active buyers. Same thing with China as well. I think that it makes sense in this type of environment where certain currencies are really starting to lag. And also with the threats of sanctions and other things like that, it seems like geopolitical tensions are at one of the highest levels I've recognized in the last 20 years. And I think that that's a reason to pare back some of that currency exposure, hold more of those precious metals within those reserves.
Since you bring up geopolitical tensions, I want to ask you about oil. And I'm wondering kind of which part of the world is going to drive and define the oil trade as we head into next year here. Obviously, the geopolitical tensions in the Middle East, but you also have China and the lack of a return to a robust consumer in the region. Which of those two do you think will define energy moving forward?
Well, I think that's why OPEC had downgraded the 2024 and 2025 outlook, that demand outlook. But yeah, you do have the de-escalation, then the re-escalation, and it's going to cause quite a bit of volatility. I think $65 crude oil, a bit too cheap, makes OPEC a little bit uncomfortable. They're unable to balance their budgets, their annual budgets at those lower levels. So I think that they'll throttle back on some of that production. We'll see prices continue to move up. We do have the U.S. and Saudi Arabia pumping record amounts of crude oil. I think that the presidential candidate will play some kind of role in the direction of oil if there's increased geopolitical tensions or if there's increased pumping here in the U.S. These things are all going to have their ebbs and flows of the market. We do favor crude oil back to the upside. It makes a great inflation hedge if prices do push up. And something to note is that the positive correlation between crude oil and the dollar index is about 85% right now. So if you see crude oil prices rise, then those interest rate cut expectations go down and the dollar goes up with it.
All right, Phil Streible, always great to get your insight. Thanks so much for hopping on and joining us here this morning. Blue Line Futures, a chief market strategist.